Welcome, everyone, and thank you for attending today's webinar. I'm David Shaw with FO Pro, the Family Office Professional, and Family Business Magazine, and I'm really glad that you're all here, and I hope you're all well. Today's webinar is going to look at structured ways to evaluate commercial real estate as part of a family office allocation. The decisions that need to be made before capital moves, not after. We will cover the full landscape, traditional and alternative property types, the access vehicles available, and the strategic postures that position a deal along the risk spectrum. It should be a very interesting and informative session, and I hope you get a lot out of it. Before we get started, some housekeeping details. If you have never joined one of our webinars before, you can ask questions. You can enter questions, ask questions throughout the presentation, make comments, and you just use the ask a question bar down below where you see the slide. We'll get to as many of those as we can. We'll go for no more than 60 minutes today, and you will be able to get the slide presentation afterwards as well as a replay. I'm joined today by two experts in the commercial real estate area. They're Realberry's Derek Evans, who is the CFO of Realberry, and Stephen Dennis, Vice President of Tax and Equity. Derek oversees corporate finance, accounting, debt, capital markets, asset management, and fund management, and works closely with the company's executive leadership on enterprise-wide financial operations. He partners with Realberry's investment teams and executive committee on capital formation at the property, fund, and corporate level, balancing long-term hold objectives with investor liquidity needs, and he directs the company's balance sheet strategy, including cash flow, capital structure, treasury, and liquidity planning. Stephen oversees federal and state income tax compliance, sales use and excise taxes, tax planning and forecasting, partnership operating agreements, capital calls, and distributions across the company. He also serves as the primary point of contact between Realberry and its outside tax advisors and supports the investor relations team by answering investors' tax-related questions directly. Welcome, both of you. It's a real pleasure to have you with us today. I'm going to turn this over to Derek to get us started, and I will be back with questions and comments, hopefully throughout. So have a really wonderful session, and see you soon.
Great. Thank you, David. And we really appreciate the opportunity from FO Pro to host us today. It sounds like we've probably got a couple hundred people out there watching, so nice to meet everybody. I thought David did a pretty good job introducing Stephen and I thought I would give just a quick overview of who Realberry is to help set the stage. So we are a diversified real estate investment company based in Denver, Colorado. We have about $3.5 billion of assets that are spread across a variety of different product types. These product types include hospitality, multifamily, office, industrial, retail, mixed use, and then we have a fairly large master plan community business here in Colorado. Most of our business is done in Colorado, Texas, and Utah, outside of hospitality, where we have a national scope. We're also vertically integrated, so we do just about everything in-house outside of we don't property manage our own apartments, and we don't do our own GC work. One other thing that I think is important about our company that I think is useful for today's conversation is throughout our 35 years, our main source of LP capital has been family office capital. So we feel like we have a pretty good idea of the type of considerations that family offices and families are thinking through as they're looking to make real estate investments. Before I continue, Stephen, anything you want to add to dive deeper on what our tax department looks like?
No, I think we're good.
Okay, great. So before we get into the agenda, my legal team tells me I have to make this disclaimer. So today's presentation is solely for educational purposes. It's not investment or other professional advice and is not an offer to sell securities. So as we think about the agenda for today, what I really want to highlight is, first and foremost, I'm assuming that most of this audience has invested in real estate either directly or passively through sponsors, and I'm also assuming that most people are thinking that we're probably at the start of our next real estate cycle. The last 4 years, needless to say, have been fairly bumpy, but it does feel like we are starting to see the green shoots, and that real estate recovery is either starting to happen or is coming pretty quickly. So what we really wanted to cover today was an overview of different real estate strategies, some considerations for family office investors, and then a deeper dive into some tax considerations. And then hopefully when we're done, the data you found it helpful as you begin to make investment decisions coming into this next cycle. So to start off, I thought we could go into some of the types of real estate investments that you can make. And I've broken it down between traditional and traditional real estate, and I think what would be broadly defined as more alternative strategies. So, within the traditional category, you have your main food groups of office, retail, industrial, and residential. Those have always been kind of the main four. And then you also have hospitality, net lease, and then land development. What I would tell you as it relates to kind of the traditional sector, office has been frankly out of favor. I think that's probably true across most markets in the United States, outside of maybe New York. Retail, 4 or 5 years ago, when we were in the depths of COVID, everybody thought that retail was over, and now it's actually a darling and a very attractive investment. Industrial and residential, in particular from a development perspective, I would say are out of favor right now, primarily given supply concerns, depending on the market. From a resi perspective, multifamily acquisitions are an area that we're seeing a lot of activity in, and then also in the 55 plus area of the for rent product. Hospitality, luxury in particular, is an area that has really thrived over the last 3 or 4 years, as you kind of look at our new K-shaped economy and the significant new wealth generation that's really happened coming out of COVID. Net lease, which might be an area where many of you invest in because of the 1031 nature of those transactions, which I know Stephen's going to get into a little bit more here shortly. But that's always been a pretty attractive space for people to be in. And then land development really kind of depends on what area of the country you're in. As an example, if you're in certain Texas markets, land development remains a very attractive investment. Or in other markets where you're having slower growth, that's not the case. And then quickly, from an alternative investment perspective, I'm sure all of you read the Wall Street Journal every day. Data centers seem to be at the top of everybody's mind. This is an area over the last 15, 20 years that has really expanded. And in particular with the AI boom, you're seeing even a greater expansion. I think one consideration there is you now have a lot of what I would call community political backlash on data centers, which is getting a lot of news and is something to consider as people are evaluating those type of investments. And then the other thing I'd like to point out here on the alternatives is healthcare. Healthcare is an area where I would say, generally speaking, it's always been considered an alternative investment, but it's clearly becoming more mainstream, especially as you have aging population within the United States. And so the growth in the senior housing sector, skilled nursing sector, and really the end user of those products wanting to have a high quality experience has led to dramatic growth. And the capital deployment that's coming into healthcare is like we haven't seen it in history. It's generally been not a very capital inflows into healthcare as we're seeing now. So with that, let's go into the different avenues that you can invest as you think about these product types. And I want to, I'm not going to hit all these, but if we start on the far right, this is really the do-it-yourself, right? So many of the people that are on this call, potentially that's how you initially got into real estate. Maybe you were a manufacturing company, you owned your own building, and then ultimately you sold your business and you became more of a passive real estate investor. So that's kind of the far right of the spectrum. And then everything else to the left of the do-it-yourself is really more of a passive strategy. And so when you look at these other strategies, your most liquid and quite frankly, the most pure liquid form of real estate investment is the public REITs. And we'll talk about the illiquidity of real estate as we get further on into the presentation. But the public REITs will have the most transparency and access to daily liquidity. Your private non-traded REITs, this is an area that's grown significantly over the last really 2 decades. The 2 names that really come to mind are the few names is obviously Blackstone with their B-REIT product. Starwood has S-REIT. Ares has public non-traded REITs. And these have really expanded to give what I would call the accredited investor greater access to those types of sponsors. These vehicles are often sold as being liquid, but the reality is they don't trade like a public company, and they are subject to redemption queues. So something to be aware of. And then private equity and hedge funds. My guess is a lot of people on this phone call probably invest in this sector. This is generally closed-end vehicles, so they may have a 10-year life where you are making a capital commitment. You have to fund that over time, but then you actually don't get your return of capital until the fund is wound down. So a very illiquid investment. Odyssey funds are large core funds. Examples include Invesco, Clarion. These have generally only been available to large institutional investors. They're generally investing in core type of product and are low leverage profiles focused on cash flows. Interval funds are something that's been really new over what I would call the last decade in real estate. What's interesting about interval funds is they actually give smaller investors access to the Odyssey funds. And that's generally a portion of the investment profile of those interval funds, with the other portion being the public REITs for diversification and liquidity. And then last, the direct with sponsor, which is obviously going direct with someone like a Realberry, where you're investing on a deal-by-deal basis. And we'll talk more later about some of the considerations as you're going direct with the sponsor.
Thanks, Derek. So with that, obviously there's a number of avenues by which you can invest in real estate. And most people want to understand, ultimately what is the tax treatment of the different avenues of real estate investments. And I would say that the primary 2 that we see are either through REITs, which come in the means of dividend income, or by means of an LP interest, which gets reported on Schedule K. So let's talk a little bit more about REITs first. REITs are a unique tax classification by which the REIT has to distribute at least 90% of its income on an annual basis in order to retain the REIT status. A REIT dividend typically is paid out of like operating income from a REIT and will be reported on a 1099 div that's issued from a brokerage house. And those are typically issued, I think the deadline for those is around February each year. So there's 3 different dividends you might see on a 1099 coming from a REIT. The first is an ordinary dividend, which again is typically from ordinary income operations from the REIT's underlying portfolio. Those are taxed at the ordinary tax rates for investors and are eligible for a 20% deduction under Section 199A, which I'll get into a little bit more later today. The second is capital gains distribution. So that is when a REIT sells its underlying property and distributes the funds. Those show up as a capital gain distribution and are eligible for capital gains treatment. And then lastly, we have non-dividend or return of capital distributions, which are non-taxable distributions. So that's really the first mechanism that we see for tax for investors in real estate. The second, which we deal with a lot more here at Realberry, is the fund or the partnership structure. These are called flow-through interests. And the reason for that is because all of the income and deduction that is incurred at the partnership level ultimately flows through to the individual investor. So the business does not pay the tax on behalf of the investors. The business will report all items of income, deduction, depreciation, which we'll talk about here in a little bit, and it will report it to investors individually on Schedule K1. The mechanism of that is usually defined by the operating agreements behind these mechanisms. And so it's really important for investors to understand what's in those operating agreements and how these items of income and deduction are allocated to investors. K1 delivery can vary a lot differently from the 1099s. The partnership extended filing deadline is September 15th. So investors may receive K1s anytime from February to September 15th. So there can be a little bit of a delay there depending on how fast the CPA firm is working. The last thing I want to clarify with the Schedule K1, and I think is a question we get a lot from investors, is are distributions taxed kind of like they are with REITs? And the answer is no. Distributions from partnerships are non-taxable to the extent that you have basis in the partnership. Really, it's the items of income and deduction that are reported to you on the K1 that become taxable, but any distributions that are distributed to you personally are non-taxable in general.
All right, great. Thanks, Stephen. All right, moving forward. So I wanted to talk a little bit here about the different types of real estate investments as you think about a risk versus return threshold. So generally speaking, the types of real estate that we've been through are placed in 5 different buckets, starting at core, which is going to be generally a stabilized asset, a lower leverage profile. It could be a trophy office tower. It could be a large mall, power center, but generally something that's just kind of steady Eddie. Then you get into Core Plus, which has a lot of the same traits as a core asset, but there may be a little bit of lift in terms of some leasing that has to happen, or maybe some minor improvements that would provide a little bit of lift on that asset. From there, you hit value add. So this would be an acquisition. Maybe you're buying a vacant building where you've got to divide up an industrial building and release it. It's a power center where you're at 80% occupancy and need to take it to 100%. It's a Class B apartment that you want to renovate into a Class A apartment. And then next we go into opportunistic. This is generally development, or it could be a major repositioning or an adaptive type of reuse project. And then last, distressed, right? And these could be assets that are being bought from a lender, as an example, where the underlying risk profile of that asset lends itself to being of a distressed quality. So I think the important thing to consider around all this is lower the risk, lower the returns, higher the risk, higher the return profile. The other thing, as you look across all these different types, is as you look at core and core plus, those are generally going to be cash flowing assets where you're going to be receiving distributions from the onset, where when you get into value add, opportunistic, and distressed, those are generally not instant cash flowing assets, and you generally are not receiving distributions until the sale of the property.
Just a quick question, Derek, back to that. Is there a formula that you guys use, or I'm sure it's not a formula, but how do you create a portfolio out of these 5 different kinds of investment types? I'm assuming you have a little bit in each.
Yeah, so good question, and it kind of goes back to the different platforms that I highlighted a few pages back, right? It really depends on what the investment strategy of the sponsor is, right? So it would be very rare where you would find a sponsor who does all of these things, right? So the funds as really core, maybe some core plus. The private equity vehicles, as well as the individual sponsors, are more value add and opportunistic. The hedge funds are typically going to be more distressed. So it really just depends, David, on what that sponsor's strategy is. I would say for Realberry, as an example, we are more of a value add and opportunistic sponsor.
Got it. Okay, thank you very much.
We talked about the different real estate products and different type of sponsor vehicles. And when you think about those and dive a little bit deeper, there's really only 3 strategies that fall within all of those buckets. And those 3 strategies are acquisition, development or construction, and then debt. So as you think about acquisitions, and I've said this previously, that's generally going to be your core plus value add type of plays. And so there you generally have the ability to have cash flow distributions out of the bat. From a development perspective, this is more opportunistic. I would say for development, generally, to invest in development, you're likely going direct with sponsors. The REITs don't do a lot of development. Your private equity funds may do some, but generally they're capped to, call it 25 to 30% of the equity that's been committed to a vehicle to actually to do development. So in a lot of situations, if you want to invest in more opportunistic real estate like development, you're often going direct with the sponsor. Last is the debt piece, and I would say this is an area in particular that has grown significantly coming out of the GFC. I always tell people this. I don't think these numbers are anywhere close to being accurate, but I think pre-GFC there was maybe 10 names that were investing in real estate debt. And if you look at where it's at today, it's literally hundreds of names of sponsors that have gone into the debt business. Generally, when you're investing in real estate debt, it's done through either debt funds, which is private equity, or mortgage REITs, which are the publicly traded mortgage companies. I think what's interesting here about debt, and again, I spend a lot of time reading the Wall Street, so I'm assuming other people do as well. A lot of people over the last cycle have invested in debt because of the current yield, and I think the perceived less risky nature of that because you're in a senior or in a secured position. I think the problem with that is as we've gone deeper in this cycle and you have more and more sponsors wanting to do debt, for those people to get capital out, the reality of having to go down market and take more risk is very real. So I'm personally of the belief that as we get through the next 12 to 24 months, and we're already starting to see some of those cracks on the private credit side, you're going to start to see some distress within the various type of debt vehicles that are investing in real estate. But generally speaking, these are the three type of avenues you have to invest in real estate across the various products, and then with the various type of sponsor vehicles.
Thanks, Derek. So with that, I really want to jump into what I believe to be one of the main tax advantages to real estate investments, and that is the concept of depreciation. We get this question a lot from investors who really want to understand exactly what depreciation is. And depreciation is essentially the deduction that the tax code allows for the wear and tear, aging, gradual obsolescence, I guess, of the building over a period of time. And so the one caveat there is that land is not depreciable, but the building structure and its components are depreciable. And we'll talk about kind of the class lives that the IRS assigns to those in a second. But one caveat I want to add there as well is that Derek just talked a little bit about acquisition versus construction. A lot of investors want to know, how soon can I start seeing these depreciation benefits? And the answer is, for an acquisition, those depreciation benefits are immediately available. But in a construction deal, if you have a 3 to 5 year construction period, you're actually not going to get the benefits of those depreciation until the project is delivered and has been placed in service. So just wanted to make sure that was something we hit on here today. So in general, when you're looking at the depreciation for a building, the IRS defines most non-residential real property, which would be your office buildings, your hotels, commercial spaces. That's eligible for deduction over a 39-year period. Residential rental, which is multifamily primarily, is going to be deductible over a 27.5-year class life. And that's on a straight line basis. So, from a very simple perspective, you're just taking your building basis and dividing it by the number of years. And then you're eligible for a deduction each year. The key mechanism there is that this is a non-cash deduction. So you've already presumably, the money's already been invested, or debt's been, secured, and the property's been acquired, right? So this is a non-cash deduction that you're getting on a yearly basis without actually having to put more cash into the business. So some of the other items that are depreciable over a shorter life, which we'll talk here more in a second as it relates to bonus depreciation, would be, you've also got personal property, which would be computers, equipment, appliances, office furniture, fixtures. You might have tenant improvements, land improvements, parking lots, or qualified improvement property, which would be any interior improvement made to an existing commercial type. All of those different assets have shorter class lives per the IRS and are eligible for what's called bonus depreciation. So let's talk a little bit about bonus depreciation. Many of you are probably familiar with this topic, but this has been a big point of emphasis with a number of legislation over the past decade or so. And the percentage has varied, but the one big beautiful bill, which was passed in 2025, permanently extended bonus depreciation to 100%. So what that means is any of those assets in the 5, 7, 15-year class life, all of those items are eligible for a 100% deduction in the first year that it's paid for or acquired. And that can be a pretty big deal for investors. If you have a fairly large tenant improvement that needs to be done, or you have a pretty large, hotel renovation, or maybe you're replacing all the FF&E in an apartment complex, those can be really big numbers and can really add a lot of value for investors by passing out those deductions in the first year, as opposed to spreading that out over a much longer period of time. And so that leads me to talk a little bit about cost segregation. So this is a technique that we use quite often here at Realberry. Cost segregation is a study that an engineering firm typically will do. So These guys are engineers or architects and will go in and look at building plans. They'll look at site drawings. They'll go out and visit the property. And what they're really trying to understand is how much of the building basis can we split into these shorter class lives and take accelerated depreciation on. And so this is an IRS approved method, but really can end up providing a substantial depreciation deduction to investors early in the life cycle of a project, which again is a non-cash deduction for investors. So with that, let's talk a little bit more about holding periods. So I think most people are familiar with the general rule as it relates to holding period for real estate investments. Anything less than a year is generally considered short-term, but anything held for 1 year or longer would generally be considered long-term capital gains. And that's one of the really big advantages for real estate investing is as you're getting these depreciation deductions, which can help shelter your taxable income, you're getting those deductions at ordinary tax rates. But when you ultimately sell and you're able to get long-term capital gains treatment, you're paying at a much lower capital gains rate, and that rate arbitrage can mean a lot for investors. You know, the top ordinary rate is 37%, and the top capital gains rate is 20%. All the depreciation that we just talked about is actually recaptured at a slightly higher rate, which is 25%, but nonetheless is still a much lower rate than that 37% deduction that you're getting as you're taking those depreciation deductions. One thing that we wanted to add here and is the intent behind the investment. And so, you know, most passive investors in deals really just come in as an investor, and they're not materially involved in the business. They're not, you know, doing any fix and flips or anything like that. The IRS looks at those people, and those people are eligible for the long-term capital gains treatment because they're considered investors. However, if you're a dealer, so think of the people that are doing fix and flips or doing land development, anything that looks more like you're maintaining inventory versus holding an asset for long-term investment, the IRS does look at those dealers as earning ordinary income as opposed to the capital gains income. So we really recommend that, you know, you work with your CPAs to make sure you understand which of those two categories you fall into.
Stephen, I don't know if you can offer advice on this, but this comes from a family office, I think, that owns some older real estate. And on the subject of depreciation, what would you advise if our depreciation schedules, which were physical paper files, were lost over time? What do we do?
Where depreciation schedules were lost over time?
Physical paper, just gone.
Yeah, that's a great question. You know, at the end of the day, I think there still needs to be some record keeping that needs to be done, but that's where I go back to the cost segregation team. You know, I think hopefully there's still some record out there of what was paid for the building. And over time, you kind of have a sense for how much was allocated to the different class lives. But if not, I think cost segregation teams are a really good avenue to pursue to kind of help you understand, you know, what assets do I own? How much depreciation have I taken over time? And maybe did I miss any depreciation deductions over the past however many years, and see if we can maximize those in this current year. That's one of the other things I think people don't realize about cost segs is you don't have to do them in the first year. You can do a cost seg 10 years after you acquire the asset and kind of go back in time and still get the benefit of some of those depreciation deductions that might have been missed.
Nice. Thank you.
Okay, doing a time check here. I think we're doing pretty good. We've probably got about 6 or 7 more slides. So here real quick, what I'll touch on is just the capital stack for a typical real estate transaction. I think this is important from two perspectives. First, risk, and then second, I think investment options within the cap stack that you may think of from an investment perspective. So a typical cap stack for a real estate transaction is going to be your sponsor co-invest, the LP capital coming in from a family office as an example, and then senior debt, right? And in that typical structure, the risk profile is going to vary really by how much leverage you use. Lower leverage, less risk; higher leverage, more risk. Then On the opposite end of the spectrum is what I would call more of a risky cap stack, where now you have added in maybe pref equity, maybe a strip of mezz debt. And when you start to talk about these additional layers of the cap stack, more risk equals, less room for error, right? So less room for error given interest rate volatility, less room for error in terms of construction delays, lease up risk, all of those things. So as you are looking at transactions, understanding the different layers of the cap stack is going to be very important. The other piece of this would be from an investment perspective. My guess is a lot of people are seeing the opportunity to invest in pref equity, which has priority over LP capital, generally comes with a higher coupon. People may be looking to invest in mezz debt, which obviously has a higher coupon as well and can come with some share of the upside in a transaction. So just really wanted to kind of set the stage here of just kind of the importance around understanding the different layers of a cap stack in a transaction. Next, from an underwriting perspective, really wanted to zero in on some risk considerations that you should be thinking about as you're looking at both deals and sponsors. The first is, and we talked about this earlier when we went into the different type of vehicles that you can invest through, is that real estate's an illiquid asset class. Outside of investing in public REITs, it is illiquid, which means that you are not going to have the ability to get liquidity until an asset sells, or depending on the type of fund vehicle that you're in, it may be a quarterly redemption queue, which depending on where we're at in the cycle, that redemption queue and the sponsor may not have the liquidity to be able to exit you. So this isn't something where you should feel like, again, unless you're investing with a public REIT, where you're going to have instant access back of your capital. Second is market conditions. I think here the market condition risks impacts not only the overall real estate sector, which is generally cyclical in nature, but also individual product types, right? So you have macro events and macro traits that impact real estate, interest rates, capital availability, geopolitical risk, construction costs, cost of materials, and then you have micro market conditions as well, where it could be the supply in a certain market. It could be, we see a lot of this now, the wildfire risk, convective storm risk, all of those things. And so understanding whether it's by the overall sector or a given product type, what those market conditions are that may impact your investment, it's important. Product type sensitivity. So different assets, different asset classes have different risks that you need to consider when underwriting. I think when you look at kind of the spectrum, I would say you kind of look at like the net lease assets on one side, and then maybe you look at office or hospitality on the other end of the risk spectrum. And within those product types, there's different characteristics that impact the risk of the investment. So generally, the riskier the product type, the higher the return. The less risky, the lower the return. The next thing to consider from an underwriting perspective is capital intensity. So again, you kind of have the net lease space on one end of the spectrum. Same thing, I would put storage in there, where it's not a very capital intensive asset class. The other end of the spectrum, you have office and hotel, where you have to put considerable dollars in to re-tenant the buildings, to refresh the property. Why all that is important is the more capital intensive a project is, that means the more money that you're going to have to reserve to take care of those events. which means less distributable cash flows to you as an investor. And then last is sponsor dependence, which we'll talk here a little bit more about in a couple more pages. But generally, unless you own real estate directly, you are dependent on the sponsor and their management team making the best investment decisions for that specific investment or property. And this is one I think is very important as you think about investing with sponsors.
All right, so some other tax considerations that we wanted to bring to light here that is very important for real estate investors. So one of the questions we get frequently is, am I a passive investor or an active investor? And what does that mean to me from a tax perspective? So by default, rental or real estate activity is treated passive by IRS regulations. You have to prove affirmatively that you're an active real estate investor. Think, for active real estate investors, that's if you're a real estate professional, maybe you materially participate in the business. There's a number of tests that the IRS walks through, although it's not a bright line test, but walking through those will help you understand kind of the difference. But I would say probably most of the people on this call fall in that passive bucket where you're passively investing in a fund or a vehicle, partnership vehicle with a sponsor. If you're a passive investor, it's really important to understand that you can only deduct passive losses, to the extent that you have passive income. And so a few slides ago, I talked a lot about the benefits of depreciation and what that can mean for investors, which can be a really good thing. But if you don't have passive income to offset, there's the chance that these losses may get suspended until a future year, whether you have passive income to offset or if the underlying project is sold. So just wanted to point out there that just because maybe a pro forma or a K1 is showing losses, that doesn't necessarily mean that you're able to deduct it in the first year. It's something you should definitely consult with your CPA as far as timing on the deductions there. The QBI deduction is something that came from the Tax Cuts and Jobs Act in 2017. This is otherwise known as the qualified business income deduction. The reason this was enacted was to combat the 21% corporate rate cuts that were occurring. Many lobbyists went to Congress and said, it's not fair that the corporations are paying 21%. Yet the top rate for individuals is 37%. So there are a number of tests that you have to walk through to understand if you're a qualified business. But in the event that the business is qualified, it does pass through that 20% deduction to investors. We talked a little bit about this with REITs, but all REITs are actually eligible for this 20% automatically. And I would say that it kind of varies on the LP side, whether or not the business income is qualified. It's something that highly recommend work with your CPA on, but it is something that can help offset your tax liability if you qualify for that deduction. Business interest limitation. So another part of the recent tax legislation here was that the IRS basically came out and said, we're going to go ahead and cap how much interest you can deduct based on a calculation that looks kind of at EBITDA. And they've modified that calculation over the years, but the goal was to eliminate businesses that are heavily leveraged and incurring significant taxable losses that they weren't able to take an exorbitant amount of interest expense. And so that obviously can make a big difference for real estate investors, as many of these assets are leveraged with debt. The way around that limitation is there's an election that you can make with the IRS. It's a one-time irrevocable election to be fully exempt from that interest cap. However, there is a trade-off in that you are required to elect slower depreciation lives for your assets. So all of the bonus depreciation mechanics that we talked to you a few slides ago, you're not eligible to take bonus depreciation if you make this election. So at that point, it becomes a little bit of a math equation as far as, how much interest income or expense do you expect over the coming years? How much depreciation are you able to maximize? We have those conversations with our CPAs quite a bit about when to make that election, because there's definitely a timing mechanism there. Maybe it makes sense to not make the election in the first year of the business so you can maximize those depreciation deductions. And maybe you make the election in the second or the third year. But did just want to point out that there are limitations on how much interest can be deducted. Pass-through entity elections. So if you recall back to the second slide, we talked about how most partnership interests are pass-through tax. So all of the income or loss are passed through to the individual investor, and the taxes are paid on the federal and state level at the individual's 1040. The pass-through entity election is something that came out as a result of the $10,000 cap on state taxes for itemized deductions. That was part of the Tax Cuts and Jobs Act. Most recently, that number is now up to $40,000, but still can remain a significant cap for investors who pay more in state taxes than that $40,000. So about 35 of the states came out with some legislation that allowed the partnership to pay the tax at the entity level, thereby generating an ordinary deduction that flows through on the K-1s and issuing credits to investors on their state K-1s so that they can bypass this federal limitation on state and local taxes on Schedule A of the tax return. So like I said, it's only available in, I believe, around 35 or so states, but this can be a very powerful planning technique to avoid that state and local cap. The last piece we'll touch on here is 1031 exchanges. So I'm sure many of you are familiar with the concept. This is really when you sell a property and roll the proceeds from that transaction into another like-kind real property. The key word there is real property. Personal property was permanently excluded from eligibility here. The IRS is really strict on timing with these transactions. And so typically you have 45 days to identify replacement property, 180 days to close. Those clocks start on the same day and run concurrently with one another. The other key part here is that the proceeds from the sale must pass through a qualified intermediary. So the taxpayer can never have access or touch the funds. If they do, the exchange is disqualified. And then dealer and flip property doesn't qualify either. So people that are involved in fix and flips, this, that, and the other, only things that are genuinely held for investment are eligible for the 1031 exchanges. The main talking point there, I guess, is that the 1031 allows you to defer both the gain and also the accelerated depreciation that you were able to take. And so if you're able to use the 1031 to your benefit, you can defer taxes, frankly, as long as you can. You can continue to do 1031 over and over. There's no necessarily restriction on that. So you can defer taxes in perpetuity, which is a really, really powerful wealth building tool.
Great. So David, I know we're getting close to time here, so I'm going to try to go relatively quick on these next few pages. So here, what I want to show is, these are generally the three types of return metrics that investors are looking at. And depending on the type of investor, they generally have different types of return parameters that they're looking for. In our experience, most family office investors are generally more multiple and cash-on-cash yield focused. And that's primarily because generally longer term holders of real estate and looking for current yield. So I won't talk too much about IRR. IRR is a great way to be able to evaluate across different types of sponsors and different types of product types. From an equity multiple perspective, that's obviously dollars in, dollars out. You could have a very high IRR, but have a very low multiple. So it kind of depends on, again, what your investment threshold is. On the cash on cash, this is your current yield, so the distributions you're getting versus the equity that you put into the deal. One of the things I want to point out on cash is this is a really good opportunity when you're looking at comparing real estate versus another investment of what generates the best yield for you. So as an example, you could take a sponsor is saying, I'm going to get a cash on cash yield for this office building of X, and you could compare that to what you might get on a 10-year treasury or what you may get from a REIT dividend yield. And then last, I'm not going to go through all these in details, but as you're looking at doing direct investing with sponsors, this is a pretty good list of diligence items to be asking and digging into. And I believe everyone's going to get a copy of this presentation. So given we're running out of time, I won't go through all these in detail. But the one big point that I want to make here is that when you are a passive investor in real estate, selecting the sponsor is the one thing that you control, right? So selecting who that sponsor is you're doing business with is absolutely critical, as once you've made that investment, you're solely relying on them to make the best investment decision for you as an investor and for that specific asset type. And this is just a list of some of the things to consider. So with that, I think we'll wrap and go to questions. Hopefully today we have given you guys a good overview of some thoughts around different product types, different types of vehicles, some underwriting considerations, and some tax considerations. And all of that will help you become a better informed and make better informed investment decisions as we get into this next cycle.
Excellent. So we do have a number of questions. This one is what terms, Derek, you talked about preferred equity and so on. What terms should be expected for preferred equity and sponsored carry, and what fees can be expected?
Yeah. So I would say, generally speaking, what we are seeing today is we're generally seeing, and I'll just start with kind of the LP capital stack, right? I would say generally what we're seeing for most of the traditional product types is those are coming with an 8% pref, right? This is LP capital, and then generally it is probably a 75-25 split of the profits, right? So 75% to LP capital, 25% to the sponsor. I would say that's kind of ballpark what we're seeing today. Obviously, if it's like a fund, a private equity fund, that's generally kind of an 80-20 over an 8 is how we would describe it. On an individual deal, it's generally a 75-25 over an 8. From a fee perspective, it kind of depends development versus acquisitions. You generally are going to have a development fee, probably a construction management fee. You're going to have some capital markets fees, and then you're also going to have various fees for what I would call sponsor overhead to be able to support the transaction. You can see acquisition fees, disposition fees. I mean, there's a variety, and it really kind of depends on development versus acquisitions and the overall returns in a deal. As it relates to pref equity, again, it kind of depends on the risk of the transaction. I would say generally today we're seeing pref coupons kind of in the low double digits, so call it 10 to 12, all the way to like 20% or higher, depending on the risk profile of where that pref is coming into the cap stack.
Okay. Had a couple of questions on this, just asking for your thoughts on the senior housing 55 plus community real estate play. Yeah. What are you thinking about that right now?
Yeah, so it's actually something that we're actually getting ready to break ground on our first 55 plus deal later this year, and it's different. I mean, people kind of look at it and they say, well, it's an apartment. Well, it is, except for there's some nuances that make it distinctly different. Number one, your lease up time frame is longer, and number two, there's more of a operating burden to have programming within that asset, right? And so that generally also comes with higher rents and a stickier tenant base. So we like it, right? I think it's heavily dependent. We talked a little bit earlier about understanding your market and market risks. I think one of the critical things about the 55 plus product type is when you're going to build or buy that, understanding what the local demographics look like in terms of the like median income and what those tenant profiles look like, as well as what type of amenities are close to that property. So as an example, the deal that we're getting ready to break ground on is part of a mixed-use town center development that we're doing that's anchored by a Whole Foods. And literally the tenants of this 55 plus community will be able to walk out their door and walk into a Whole Foods. So we like it. I don't think it fits like every single submarket in the United States. I think it's really market dependent and demographic dependent.
Okay. And another question, several people were asking about this, but the supply of multifamily has reduced. And, have you seen any pickup in development? And do you have any expectations of a return to quote unquote normal supply of multifamily?
Yeah, you know what? Those are great questions, and I wish I had a crystal ball. And we literally talk about it every day. Yeah. We're developers at our core, and we have developed over our history thousands of apartment units, and we're waiting for the market to come back. It is accurate, like supply is way down, but we still haven't seen the fundamentals return. So supply is down. But we're still waiting because we really kind of had 4 years of supply that hit in like a 2-year time frame, right? And so we're waiting for all that inventory to absorb, and why it's absorbing the concessions and the rent pressure that we've seen in our markets doesn't justify new development yet. That's not to say there's not projects happening, right? I think there's a lot of stuff that's happening in more of kind of the low-income tax credit sector. We talked about 55 plus, that's happening. There's certain kind of infill sites, like depending on the market, where it makes sense to build new apartments. If I did have a crystal ball, I would tell you that I think we're probably still 12 months out before we really get to that point where you can say, hey, for most submarkets, now's the time to go and build. I think for sponsors who are able to get their deals capitalized today and start new development of apartments, I think they're going to ultimately reap rewards from a return perspective, because if you're delivering 24 months from now, and when you've delivered, you don't have other new supply coming on, and you've seen those concessions burn off, your ability to outperform is useful. It's just no one can really get over that hump of, okay, does it make sense to build today or not?
Yeah. Okay. Well, we're coming toward the top of the hour, but I'll add this final question. And for those of you whose questions were not gotten to, we will provide those to Derek and Stephen so that they can answer you directly. But this is an interesting one. What do sponsors look for in their private investment partners? What are their investor partners? You said here are some things that you should look for in a sponsor. What does a sponsor look for in the family office, for example?
Yeah, I mean, look, I think our business is a relationship business, right? So we want to do business with aligned capital partners, whether that's a family office or whether that's an institution. We want an aligned relationship and a transparent relationship. So I think for us, we want to do business with people who understand, Realberry as a company, who understand real estate and the risks related to real estate, and then who have the ability to do more than one transaction, right? It's true with anything, kind of like the 80-20 rule, right? Like we want to do repeat business with people, and we want to do repeat business with people that we like.
Okay, fair enough. A great answer too. So let's bring ourselves to a close here. I want to say to everyone, thank you to all the family offices with great questions here. And if you are looking for an event where you can do some more work on improving the connection between the family and the family office, come and join us next month at the Align Conference at the Crescent Court Hotel in Dallas, Texas. You can you can hit that QR code and learn more there. I think it's going to be a spectacular conference with some amazing speakers. And speaking of amazing speakers, Derek and Stephen, thank you very much for really going through this well. I would say, based on the comments here and the questions, you guys hit it out of the ballpark. And so thanks. And with that, everyone, I hope you'll join us for our next webinars, and we'll see you then. In the meantime, have a great rest of your day.
Thank you, guys.